Bloom. Energy just lost nearly a fifth of its market capitalization in a single trading session. That is not a dip. That is a structural conversation happening in real time. The stock hit an 18.5% drawdown on volume, roughly 3 times its 90-day average, which means this was not retail panic. Institutions were moving. So the question is not whether this hurts. The question is whether the market just made a rational reassessment of Bloom Energy's future cash flows, or whether it handed a specific type of investor a window that closes fast. That distinction is worth understanding precisely. Let's be precise about what happened, because the financial media will compress this into a single sentence and lose all the texture that matters. Bloom Energy reported quarterly results that missed on 2 of the 3 numbers Wall Street cares about most. Revenue came in below consensus. And more critically, gross margin guidance for the forward period was revised downward. The company cited input cost pressures, specifically the cost structure around solid oxide fuel cell manufacturing, and a project delivery timeline that slipped on 2 large utility-scale contracts. Neither of these is a catastrophic revelation. Both of them, however, violate the implicit promise a growth stage clean energy company makes to its institutional holders. Here's what that promise looks like in practice. You tolerate a company that is not yet consistently profitable as long as it demonstrates clear progress on 2 vectors: margin expansion and contract execution velocity. When a single quarter breaks both simultaneously, the fundamental thesis for holding the stock weakens measurably. Institutional risk managers do not wait for a second data point to confirm. They reduce exposure on the first signal and reevaluate from the sidelines. This explains the volume signature. The 3x average volume is not panic from retail holders. It is systematic position reduction from funds that had Bloom Energy and clean energy or infrastructure thematic baskets. They are not making a statement about Bloom Energy's long-term viability. They are responding to a rules-based signal that says the margin of safety on their thesis just narrowed. The actionable insight here: when a stock drops on both a miss and a guidance cut in the same report, the first day of selling often is not the last. Watch the next 72 hours of price action before drawing conclusions about where the stock actually wants to settle. Now, for the more interesting question, because the size of the move deserves scrutiny separate from the trigger. Bloom Energy has historically traded at a premium valuation relative to its current earnings, because investors are pricing in a future where large-scale distributed power generation, particularly for data centers, which have a power demand problem that is not going away, becomes Bloom's primary growth engine. The data center electricity thesis is real and documented. Hyperscale operators have been explicit in earnings calls throughout 2026 about the inadequacy of grid infrastructure to meet their power needs on the timelines they require. Bloom's solid oxide fuel cell technology is one of a small number of credible on-site generation solutions at the scale these operators need. That structural thesis did not change on this earnings report. What changed is the timeline and the confidence interval around the margin profile. So let's do a simple framework calculation. If you strip out the thematic premium and value Bloom on a more conservative forward revenue multiple that reflects the execution risk now priced into the name, the stock was already trading at a level that assumed near-perfect delivery. The guidance cut is essentially the company acknowledging that near-perfect delivery is not the scenario for the next 2 quarters. Does that justify 18.5%? On a pure discounted cash flow basis, probably not, unless you believe the margin compression is structural rather than transitory. On a market mechanics basis, yes, because stocks priced for perfection reprice violently when perfection is deferred. The distinction matters. Violent repricing is not the same as permanent value destruction. Here's where it gets interesting for investors who are not subject to the same institutional constraints. The forced selling from thematic funds creates indiscriminate pressure that does not distinguish between the company's long-term economics and its near-term execution stumble. That gap between price and intrinsic value estimate is where patient capital historically earns its returns, with the caveat, and this is not financial advice, that identifying a gap is the beginning of analysis, not the end of it. Bloom Energy is a case study in a repeating pattern that is played out across clean energy, biotech, and AI infrastructure names throughout the past several years. Understanding the mechanics removes the emotional confusion when you see it happen to the next stock in your portfolio. The pattern has 4 stages. Stage 1. A company occupies a genuinely important emerging category. In Bloom's case, distributed power generation at the intersection of decarbonization and AI infrastructure demand. Stage 2. Institutional capital enters early, driving the valuation to levels that embed significant future growth assumptions. Stage 3. One quarterly report fails to confirm the trajectory, triggering systematic position reduction from the holders who entered in Stage 2. Stage 4. The stock overshoots to the downside because selling begets selling, and retail holders who bought the story, not the math, exit at the worst possible time. Stage 4 is where the damage concentrates for unprepared investors. The people who lose the most in an 18% single-day move are almost never the institutions who triggered it. They had stop-loss parameters, hedges, and position sizing discipline. The outsized pain falls on investors who held a concentrated position without a predefined plan for exactly this scenario. So here is the practice that separates serious investors from the rest. Before you enter any high multiple growth stock, literally write it down, the specific conditions under which the thesis is broken versus temporarily impaired. For Bloom Energy, a broken thesis looks like loss of a major data center partnership, a technological failure in the fuel cell stack, or a sustained margin compression that suggests the competitive moat is narrowing. A temporarily impaired thesis looks like a 1-quarter execution delay on 2 contracts and input cost headwinds in a period of broader supply chain disruption. Those are different situations requiring different responses. Today's move is currently reading as the second category. But that assessment needs to be revisited at the next earnings print, which is precisely the kind of ongoing evaluation that distinguishes investors who compound wealth from those who just absorb volatility. So to close the loop on where we started, Bloom Energy dropped 18.5% because it simultaneously missed revenue and cut margin guidance, triggering systematic institutional selling in a stock that had no margin for error priced in. Whether the move is justified depends entirely on whether the execution stumble is transitory or structural, and that answer is not available yet. The bigger question this raises: how many other AI infrastructure power plays are priced with the same zero-tolerance valuation? That is exactly what we are covering next. Subscribe so you do not miss it.